somewhat obvious. All right. So now.
Oh, about the test, I think you should.
No, I have already said that.
No, I know, but I'm saying you said to tell you about the time.
Oh, I've said everything.
You said that if you wanted more time to ask you for it.
She's talking about the
I already talked about everything on the test.
Okay. Sorry, I was.
Okay. Then we go to the last one, the periodic LIFO system. The LIFO says last in, first out. So when you have last in, first out, now the assumption is reversed. Now you're assuming now what was purchased most recently got sold first. Once you make that assumption, now you're saying, now you go backwards. Now you're saying you don't have to sell that 500 to get to the next one. You start going backwards. You're saying that all my sales happened, even though I told you exactly what the dates are, we assume that these dates are not known to you. All you know is that you made total purchases of so much, and you had beginning inventory, and you had total sales. So we now say, all right, so we went backwards on the sales, and so our inventory of 100 units, where is it coming from now? Exactly. There you go. From the beginning inventory. That's what is still left. The earliest in the system, the beginning inventory, that is still left in the system. Because all the new ones got sold first.
Yeah, basically everything that you stacked on top, we take it from the top instead of the bottom of the top.
Now what you're saying is that once you stack up, when you sell, you take from the top of the stack. You keep selling from the top of the stack, so that means the earliest, the latest ones get sold first, and so the bottom of the stack is still left, which was the earliest in the system. So our 100 units that we have, okay, the 100 units that we still have in inventory, those 100 units are coming from where? The earliest purchase or the earliest items in the system, which always is the beginning inventory. So that came from the previous period. So we moved from the previous period. So our ending inventory is actually going to be priced at the same cost of the beginning inventory of $1. So our ending inventory is only 100 times 1 or $100. So that's your ending inventory. Again, now subtract the ending inventory from the 1760. That gives you your cost of goods sold.
I know that has nothing to do with this, but why would a company use last in, first out?
Okay, you will see that.
They're going to end up
we'll see that soon.
more inventory.
No, we'll see that soon. There is a good reason why companies would prefer the last in, first out. Yeah. I'm not going to that.
Does it depend on the product sold, of what you're selling?
That is also true. If you want your inventory, see, look, there are. Okay, let me reiterate this. Let me reiterate this too. One more time. You have a physical flow taking place, and you have an accounting assumption. Right off the bat, I'm telling you that the accounting assumption may have nothing to do with the physical flow. So everybody understands that? Now, your question pertains to what you want to make them both consistent. That you want to reflect the physical flow in the accounting assumption. You can do that. You're welcome to do that. So therefore, if in a business where the last in gets out first, you can use LIFO in the accounting system. So that way you can make it consistent between, there should be consistency between accounting assumption and the physical flow. There's nothing preventing you from doing that. It's an option.
The takeaway is that these are just the general.
You can certainly do that. So you can certainly say that yes, physical flow is FIFO, I'm going to use FIFO. Right?
Yeah.
So that's fine too. Anybody else has any questions on this? Okay, so far so good. Is this clear to everybody?
Yeah.
How we got this? And how important that equation now becomes beginning inventory plus purchases. Because remember, no matter what the assumption is, the left-hand side never changes. The 1760 is always the same, 1760. So depending on the assumption, what you're doing is you are determining the cost of goods sold and ending inventory, meaning that you're allocating that 1760 between ending inventory and cost of goods sold by using one of these three assumptions. So change the assumption, the allocation changes. And all the three assumptions are valid under GAAP, so you are welcome to use any one of the three. Except for one provision. If you are using the International Financial Reporting Standards, or the IFRS, you are not allowed to use the LIFO assumption. The LIFO is not permitted right now under international IFRS. So a company that operates in multiple countries, you will typically see when they report their inventories, they will say inventories are reported using LIFO for US inventories, and using FIFO for inventories held at other countries. Why? Because in those countries, LIFO is not permitted. So you can have, that's what I said, you can have a mix and match of all the three methods for the same company simply because they find it convenient to do it that way.
Why is the LIFO not permitted?
That's because the IFRS feels that the LIFO does not really reflect the way the physically items move. So they think that the LIFO is an accounting measure that is unrealistic in terms of the physical flow of items, so they don't permit it. At least as of now, they don't permit it. But there is a huge demand for LIFO everywhere, and we will see soon why that is the case.
Professor, so we always have to find the weighted average and then either use the FIFO or the LIFO?
No, sir.
No?
That's what I answered.
Oh,
I said,
sorry.
weighted average, LIFO, FIFO are three independent things. You don't need to do one to do the other. Never.
So the 1760 is there for the cost of, to determine the cost of goods sold for both the FIFO and the LIFO, the 1760. How else can we arrive at that number without looking for the weighted average?
You don't need weighted average. Think about it. You don't need weighted average. All I have to tell you is what's my beginning inventory and all my purchases.
Oh yeah, so I just multiply across.
The weighted average comes because of the denominator. The denominator is what gives you a weighted average price.
So something with the total cost of all the input that I have,
That's right.
then I can determine either FIFO or LIFO, but ultimately LIFO will be the easiest way to do it.
No, it doesn't matter. Either way, anyway, all three ways are okay.
Because you don't start with the beginning of your inventory cost, all you have to do is the first cost and just multiply and get higher.
No, don't worry, don't worry. It's all right. It's all right. Initially, we have to go as slowly as needed. Once the concept sinks in, then we can go faster. You're right. All right. So far so good.
Yeah.
Everybody fine with this? Okay. All right. So let's move on.
There's a mistake on that last cost of goods sold.
I'm sorry.
There's a mistake on the last cost of goods sold.
The last cost of goods sold, yes.
There's a mistake on the result because minus 100. I saw times 100. Sorry. Minus 100.
All right. Now, see, what we did was we kind of, looked at the whole period as one thing. We were not really interested. So remember, okay, so think about it. In the previous example, all the three previous computations that we did, if somebody were to ask you, okay, all right, you sold on the 1st of December, on the 1st of October, you sold 100 units. What is the cost of goods sold for this 100 units? You won't know. Because you have to do this whole thing that we did, we do it at the end of the year. At the end of the year, you actually pick how much inventory you have, put a cost for that, and then get the cost of goods sold. You cannot get in this system, whatever we have done so far, you cannot get in that system how much was the cost of goods sold every time you make a sale. You can't do that. So now what if you need it? What if you want to make a cost of goods sold information available every time there is a sale?
Isn't that what the
So you
weighted
need to
average is
move
for?
to a, sorry, what is that?
Isn't that what the weighted average is
No, the
for?
weighted average is again, it is always at the end of the period. Remember, the whole thing in the three examples that we did, at the end of the period, you go and count the inventory.
Okay.
So you have to wait till the end of the period to count the inventory, apply the ending inventory, and then get the cost of goods sold. You cannot do it every time you make a sale. So if you want that information, then we have to move. So that's why it's called periodic. It is for a period of time. The whole period is taken as one thing. Otherwise, so if you need information which is related to every sale that you make, if you need the cost of goods sold information, then you need to move to a system which is called perpetual system. Perpetual means it's like forever. It's continuous. Continuously you can get the inventory and the cost of goods sold information every time you make a sale. Yes.
Could you just scroll up a little bit more, please?
Scroll.
So,
See the scroll up, down, I don't know. So I'm going to go
Scroll
one way.
down.
You tell me. Is this the way?
yeah,
Okay.
that's fine.
Is it enough?
Yes. Thank you.
Okay. Yes, sir.
Professor, how would you account for, let's say, inventory that gets stolen?
That's typically if it is minor, that is if it's not a major item, what you do is, when you say, suppose the accounting records will show 100 units, you go do a physical count, you see only 95. So you know 5 are gone, either damaged or somebody stole it or something. Because it's a small amount, you will simply adjust the cost of goods sold, treat it as sold, you know, and then sold for zero price, right? And so your cost of goods sold will increase by the cost of those 5 units. So you can treat that as, you know, cost of goods sold, basically.
What if it's a larger amount?
If it's a larger amount, you have to treat that cost as a separate item. It's called, we use the term inventory losses. But again, it will go in the income statement, it will reduce your profits, but it will be a separate line item because it's material and the auditors will insist that you got to show it separately.
So it reduces your profit, it reduces your equity.
Yes.
Makes it easier.
Because if the profits go down, your equity goes up. Correct.
And can you, I've heard this term before, can you compensate for something, like, I've heard that if you go into CVS and a whole bunch of people start stealing a whole bunch of things, what happens is the cost of whatever items go up versus the company losing money.
No, that means that they are trying to recover that cost from you as a
But you
customer.
can do that as a company.
Well, you can always ask, but I'm the one writing the check. I may just start going to CVS. If they keep doing it all the time, if they try to pass off all their pilferages on me, I may just decide to go to Walgreens or whatever.
But in the books, how do you do it?
You can't do it, you can't do anything in the books. In the books, that's what I was explaining to her. If it's a small amount of pilferage, you can include it in the cost of goods sold. It will still reduce profits. If you cannot, I mean, look, it's simply in the books what you're doing is you're reporting revenues and cost of goods sold. If you are not able to, if you recover the loss as revenue, then your revenue is getting bumped up, so your profits will not be affected.
So you really don't have to say that transaction, that's not an important transaction for in the book.
Why not?
Because you ultimately recovered your loss.
No, you can recover your loss, but still the loss is there. You got to report the loss. I mean, I got a $200 loss, and I recovered it from my customer. So yeah, my revenue goes up by $200, but that loss is there. It will. It will. You can't just forget it. I mean, the fact that you recovered it means that it doesn't go away. It's still
The
there.
Chapter 3 was talking about things that were important on putting in the books and things that weren't important. Like,
No, everything goes on the books. The point is that if it is important, it goes as a separate highlighted item. If it is not important, it gets mixed up with other items. So the disclosure, the kind of disclosure that accompanies an item in the book, that would depend upon how important it is. Sometimes an item is so important that you'll have to give a whole paragraph explanation outside the financial statements. You may have to highlight it and include a whole paragraph.
is it a monetary value added to that,
Mostly.
attached to it? Like, is there after, $1,500 or something, that's when you report?
It depends, it's usually a percentage of your total costs. It is very small, like 0.1%. And an accountant and your auditors will tell you. They'll tell you, okay, this is big enough, you gotta have separate disclosure.
But obviously, the RC Act makes me, like, if I was a chief financial officer, knowing what I'm signing off on, so I should be aware of what the numbers are.
You should be aware of what it is. The auditor will tell you whether it warrants separate disclosure or not. And so, alright, so now we move to a perpetual system where we are now going to track cost of goods sold every time we sell an item. So now what we do is in the perpetual system, now we need to have a sequencing. So now we need to know exactly when the purchase happened and exactly when the sale happened. And that's information given to you already, so you already know that. So now what we are doing is we are putting it in this format. See, on the 1st of January, we had 200 units in inventory, so that's $200. Then on the 1st of March, the next transaction happened, it was a purchase transaction on the 1st of March. We bought 300 units at 1.2. Now your inventory has 200 at 1, plus another 300 at 1.2, which is a total of $560. But that is represented by 500 units, so an average cost of $560 divided by 500 or $1.12. So the $1.12 is derived from the 560 and the 500. So, what was that? Is that it?
How did you get the dollars over there?
Yeah, that's what I'm.
560 divided by 500 is $1.12.
Ah, brilliant. Thank
So in a perpetual, we have to
Thank
do,
you.
a weighted average.
Say that again?
In a perpetual moving,
You do the weighted average on a perpetual basis, that is, you keep on doing it.
gotcha.
As and when there is new information in the system, you recompute the weighted average. That's the point. So now, our weighted average cost is $1.12. Okay? Yes, sir?
But the $1.12, if you add 200 to 300, have 500, like how can you know that what the 500 is going to be multiplied by if you don't?
No, you don't multiply that. You get that from the 560. You know the 560,
Right,
and you know the 500,
right.
so you get the 112. 560 divided by 500.
What he's saying is that the 200 and 300 above, are they the equivalent of the 500?
Yes.
But they're two different numbers.
But think about this, guys.
Running total.
No. The
You
500 is the
have
units.
200 units in the system
Just
at
imagine there's a line.
$1 each.
Right.
You have 300 at $1.20 each. So the point is that you have 500 at a total of 560,
Just pretend there's a line.
which on an average comes to 560 divided by 500 or $1.12.
So you get the 200 plus the 300, and then you get the 120.
No, you don't get the 1 plus 120. Folks, listen. Listen, everybody. Okay. Okay. You bought, so you bought 1 unit at $1. You bought 2 units at $1.20. And you bought 3 units at $1.30. What's the weighted average cost? The weighted average cost would be 1 at 1 is $1, 2 at 120 is $2.40, 3 at 130 is $3.90. So the total cost here is $7.30. And the total quantity here is 1 plus 2 plus 3 is 6. So therefore, this number, the question mark number, is $7.30 divided by 6, which is 13, 2, 1,
And it's
46. That's your weighted average cost. Okay. So now we have 500, and therefore, that's why I put a small a there to show that that's a computed number. That number is computed based on the 560 and the 500, right?
Okay.
Okay. Then now the next transaction was a sale. We sold 100 units on the 1st of October. So what is the cost of goods sold? Now you can get the cost of goods sold because you already have a weighted average cost here. So you apply the 1.12 to the 100 units that were sold, so your cost of goods sold becomes 112. So now you know what is the cost of goods sold for that 100 units that were sold. Now, so therefore what is still left in inventory? From 500, you reduce the 100, so you have 400 left. But again, the cost is still the same 112. So 400 at 112 gives you 448. It's the same thing as 560 minus 112, which is 448. So your ending inventory, your inventory at this point is 400 units at $448. Now you purchase another 800. That was the next transaction. On the 1st of November, you bought 800 at 1.5, which is $1,200. Now what's your inventory? Well, this 400 continues, 400 at 112, plus now the 800 at 1.5, which is $1,200. So again, following the same logic, you now have 1648, 1,200 units. So you recompute your weighted average, now becomes 1648 divided by 1,200 or 1.37. Now the next sale happened was for 1,100 units. Apply the 1.37 to the 1,100 units sold. That gives you your cost of goods sold. There's some little rounding here. So it's 1511, and your ending inventory now becomes 100 because from 1,200, 1,100 got sold. You still have 100 left, but the 100 will also be at the most recent weighted average of 1.37. So that's your 100.
So whenever you have a new purchase, you recalculate the weighted, okay.
You got it.
And you always subtract your current. your inventory?
We don't subtract inventory. Why are
I
we
mean,
subtracting? You
well,
have to
you-
have, this is what is available for sale at this point,
You
and you
just-
sold, so you have still left.
That's
No,
what
I'm
you
just saying like when you took like the 100 and then you got 400.
Every time you sell, you subtract from your
Right.
inventory.
Oh, so it's from the subtract, it's from the
Inventory.
sell, not the, okay.
You take what you sold and you subtract it from the inventory which you had beforehand.
Because this inventory, remember, okay, be careful here. What you, this inventory is really what is available for sale at this point. You have 500 units sitting there in inventory that you can sell right now. But you sold 100. So you still have 400 left, that's all.
So your, basically your inventory is what you start with, and then whatever you sell, it's what you're left with.
No, whatever you, after whatever,
You
see,
subtract
inventory
your
is,
inventory and it will give you your ending, right?
inventory is both what you start with and what you end with. Both are inventories.
Well, there's a beginning and an
That's
ending.
the beginning and the end.
I think you're trying to say is when you purchase inventory, it's gonna add to your inventory stock. And if you sell your inventory, it's gonna reduce your inventory
Right.
stock.
That's correct. Absolutely
That's
correct.
what you guys are getting to.
That's right.
Okay, because I was wondering what they was.
Like, think of, when you purchase, you're gonna add to your inventory. When you sell, you're gonna reduce your inventory.
So right now he's selling.
At,
This is a new
in March,
inventory.
look,
Actually,
in
okay, yes, he
in
sold
January-
and then purchased. I
in January,
see.
you started
Okay.
200, in March, you
The
purchased
purchase you
300,
added and
so
sell
it goes
you.
to 500, and in October, you sold, so it goes down to 400.
So there's a plus and minus column.
Basically.
Okay, everybody all right?
Well,
Okay,
that's okay.
all right, move on. So now you can see here, the ending inventory has changed. So as you can see in the previous case, our ending inventory was $135. In the, without the perpetual system, in the periodic system, in the same method, the weighted average method, we had an ending inventory of 135, now it's actually 137. Right? And that's because of the change in the system. So the ending inventory is different, okay? So, but again, the same thing, once you know my ending inventory, I can simply get 1760 minus that 137, that's my cost of goods sold. But in this system, you can actually get the cost of goods sold nicely because you have the cost of goods sold of 112 and the 1511, you can add the two and that will be your cost of goods sold. And you can easily verify that it meets that equation too.
Listen,
That's right there.
what like system or software they use to?
Oh, this has been around for a while. You can just, any accounting software will give you this. Any accounting software. There's nothing sophisticated about this now. Right now, if you have a software that does all your accounting, at the minimum, that software will include a perpetual system. Yeah, it should be no problem at all.
Can you do this like in Excel?
Oh, yeah. No, wait, hang on. Let me be clear on this.
Maybe if you have.
Probably that software uses an Excel program somewhere to get that information, but I don't know if Excel will directly give you this.
I do it
You
in
have
Excel.
to.
It does?
Formula.
So they have a command in Excel for perpetual periodic?
No, I
Yeah.
create one by formulas from scratch.
Oh, yeah, that means you're writing a simple program to convert from whatever the Excel computation is into an inventory computation. That's fine.
Yeah.
So as I said, many accounting software will automatically give you this. It's not a big problem.
It's not a big
All right.
deal.
So now, okay, so this was the moving average. So we call it the moving average because it moves. The average keeps moving every time you make a new purchase. And now we can do the same FIFO LIFO using perpetual. So watch this. So basically what we're doing here is that under the FIFO system, perpetual, so we have, you have the beginning inventory, okay, and then you have on the 1st of March, then you have 300 units purchased at 360, so you now have 200 at 1 and 300 at 120, which is 560. Now watch, I'm not computing a weighted average like I did last time. I'm just leaving it as it is because we don't need a weighted average in this example because it's FIFO. So now when you sell the 100, we are going to take it from the top. Why? Because it's first in, first out. So the oldest units got sold. So we are going to take it out of this lot of 200 at 1. So therefore the cost